For a brief moment, it looked as if a web address was enough to mint a billionaire. A company could lose money, own no real profits, and still watch its stock explode because the market had decided that the web was not a business tool. It was a religion. This is Saul. And the dot-com bubble was not simply a story about tech moving too fast. It was a story about social contagion among people who were terrified of looking stupid while everyone else appeared to be getting rich. By the late 1990s, the web had become the most strong word in finance. It changed rooms, it changed voices. It changed the way grown adults in suits talked about firms that barely had revenue. Add.com to a name, talk about scale, traffic, eyeballs, and early edge. And suddenly old doubts began to sound primitive. Profit sounded old, cash flow sounded slow. Doubt sounded like failure to understand the future. The early winners created the mood. Netscape went public and showed Wall Street that the web could turn young firms into market legends fast. Amazon, Yahoo, AOL, and other names became symbols of a new age. Some were real firms with strong futures. But bubbles do not distinguish carefully between real fire and stage lighting. Once the crowd sees a few flames, it starts buying smoke. Venture capital poured into startups with beautiful decks and almost religious belief. The pitch was simple. Capture users now, monetize later. Lose money now, dominate later. Grow first, explain later. For a while, the market accepted that logic because the price charts seemed to bless it. This is the first dark mechanism of the bubble. Price became evidence. If a stock went up, people treated the rise as proof that the story was true. A higher price did not create more discipline, it created more permission. Founders spent more, bankers sold more, analysts praised more, investors chased more. The entire machine began to use its own heat as proof that it was not on fire. The Nasdaq became the scoreboard of a new aristocracy. Young founders became magazine covers. Launch parties became theater. Firms that had never survived a normal economic cycle were suddenly described as if they had discovered a different physics of capitalism. And the old guard did not simply laugh from the sidelines, many joined. That is the part people forget. Bubbles rarely grow because fools are alone. They grow because serious people decide that the foolishness has become too profitable to ignore. Banks underwrote offerings. Analysts placed heroic targets on fragile firms. Mutual funds bought into the glow. Ordinary investors opened trading accounts and watched screens like racehorses. Everyone was searching for the next Amazon, and that search made everything look like it might be won. But beneath the champagne, the structure was already sick. Pets.com became one of the cleanest symbols of the madness. It had visibility, advertising, a famous sock puppet, and a story that sounded easy to understand. Sell pet supplies online. Grow quickly. Become a leader, but the economics were brutal. Heavy shipping costs, thin margins, huge marketing spend. A firm can be loved by the market and still bleed from the inside. Webvan carried another version of the same disease. It wanted to reinvent grocery delivery with huge infrastructure and ambition. Warehouses, trucks, expansion, speed. It built like the future was guaranteed to arrive on schedule. The market rewarded the scale before the proof had matured. That is how prestige contagion works. The bigger the dream, the more expensive doubt becomes. Inside the bubble, language did something deadly. It made weakness sound visionary. Losses became investment. Spending became growth. No profits became not yet. Competition became market validation. A collapsing burn rate became aggressive expansion. The words did not merely describe reality. They protected people from seeing it. Then the market began to blink. The exact moment was not a thunderclap. It was a mood change, a hesitation, a failed deal, a nervous earnings call, a stock that did not recover as quickly as it used to. The psychology of a bubble is fragile because it depends on forward motion. The moment the crowd stops believing that someone else will pay more tomorrow, the spell begins to rot. In 2000, the Nasdaq peaked and then started falling hard. Suddenly, firms that had been treated like destiny had to answer normal doubts. How much cash is left? How fast is it burning? What happens if funding dries up? Can this firm survive without applause? Those doubts were lethal. Startups that had spent like empires began dying like candles. Staff were cut, offices emptied. Stock options that once looked like private fortunes became worthless paper. Founders who had been photographed as prophets discovered that a falling market changes every face in the room. The same investors who had begged to get in began asking how quickly they could get out. That is the reversal nobody wants to believe during the party. The crowd that lifts you up can become the crowd that abandons you. It is not personal. It is liquidity looking for a door. The dot-com crash destroyed paper fortunes in public. Tycoons faded from magazine covers into legal disputes, layoffs, and silence. Some firms survived and became giants because they had real foundations beneath the heat. Many others were revealed as costumes with servers attached. The market had not been pricing firms. It had been pricing the fear of missing the future. And that fear was strong because it attacked identity. Nobody wanted to be the person who missed the web. Nobody wanted to be the analyst who sounded old. Nobody wanted to be the investor who stayed cautious, while neighbors, colleagues, and strangers on television appeared to be getting rich. Doubt stopped being analysis. It became social risk. That is why hope became a status signal. Owning the right stocks made people feel early, modern, connected to the future. Questioning them made people sound bitter or slow. In that mood, belief became a badge. The bubble was not only money, it was cultural. People were buying membership in a story where the future belonged to the brave and the cautious were already dead. But markets are brutal editors. They do not care how attractive a story feels once cash runs out. They do not care how many famous investors were involved. They do not care how many magazine covers crowned the founder. At last, a firm must meet gravity, revenue, margins, survival. The ability to keep breathing when the applause stops. The dot-com collapse did not mean the web was fake. That is the subtle cruelty of it. The web was real. The transformation was real. Some of the believers were right about the direction of history. They were wrong about the price, the timing, and the number of corpses hidden between the idea and the outcome. That is what makes this bubble so rich. The central dream was not false. It was early, overpaid, and contaminated by status. The future did arrive. It simply did not arrive fast enough to save everyone who paid any price for it. In the end, the dot-com Mirage was not powered by stupidity alone. It was powered by prestige contagion. When hope becomes a social signal, doubt starts to look stupid right before it becomes priceless. And once enough people are rewarded for believing loudly, silence becomes uncomfortable, doubt becomes deadly, and reality waits outside until the money runs out. The faded tycoons were not only victims of bad firm models, they were victims of a market that mistook possibility for proof. A website became a crown. Traffic became wealth. Narrative became collateral. For a while, almost everyone pretended that a glowing screen could replace the oldest rule in commerce. Something must eventually make money. That is the shadow the dot-com crash left behind. Every new boom still carries a trace of it, a new language, a new promise, a new group of believers who think this time the old doubts no longer matter. And every time, the same human appetite waits underneath, the desire to be early, the fear of being left behind, the hunger to turn belief into status before reality sends the bill. Thanks for watching. If this gave you a sharper view of wealth, power, and survival, like the video and subscribe for more from the Aurelius Method. I am Saul, and I will see you in the next video. Tell me in the comments, what is more dangerous in a market, a false story or a true story bought at an insane price?